They say I'll talk fast, but if you listen fast, I'll have to slow down so you can catch up. Curtis Jackson. Look at what's happening in these markets right now. Everyone on financial TV is giving me the exact same corporate canned answer about artificial intelligence, Fed rate cuts, and record stock indexes. But last week, I sat in a room packed full of institutional asset allocators down in ATL, managing billions of dollars. So I sat on the panel, I asked them two simple questions. One, how many of you use AI tools every single day? Nearly every hand went up. Then I said, no need to raise your hands for this one, but how many of you want a multi-gigawatt institutional data center built in your backyard or in your neighborhood? We just let them sit on that one. This instant contrast exposes the exact fault in the global markets today. Wall Street's pricing in infinite software promises, while Main Street's running directly into hard physical limits. Power grids, land constraints, regional geopolitical shocks, and sticky inflation rates that refuse to die down. I'm Marcus Sturman Sr., founder of the ABC Squared and host of the Main Street Meets Wall Street podcast. We're going live right here, right now in Charlotte, North Carolina. The Wall Street is south. We got a little storm coming in. Let me know if you can hear us. Let us know where you're tuning in from. We're live. For those who don't know the numbers, Charlotte isn't just observing, global finance from the sideline. We control over $4 trillion in headquartered banking assets, standing firmly as the second largest money center in the United States behind New York. It's the primary headquarters for Bank of America and Truist and the nationwide operational engine for Wells Fargo, Vanguard, and Barron's. This city sits at the exact intersection where institutional capital flows data into real-world commerce. That's the mission of the Wall Street South Journal, right? We don't deliver speculative hype, and we don't repeat PR press releases. We bring Main Street real talk straight to Wall Street capital, giving business owners, executives, self-directed investors the unfiltered institutional mechanics required to build, preserve, and scale truths, intergenerational wealth, something you can pass down. Now, why does this perspective matter to you? Because you've officially transitioned out of the era of easy money and predictable central bank forward guidance. When we look across the macroeconomic landscape right now, analyzing these markets is like stepping outside and asking whether it's partially cloudy or partially sunny. It depends entirely on where you stand. On one hand, you have massive capital expenditures driving mega cap tech. On the other hand, you have a bond market, which is the absolute big brother of financial assets, signaling that inflation isn't touching 2% anytime soon. And then we still have geopolitical conflicts threatening to push oil right back above $100 and right onto our doorstep as the consumer. If you're trying to navigate this environment using 2020 rules, you're going to get caught in that leverage trap. We saw the leverage trap as it was happening over in South Korea. Those markets and the concentration with the Kospi, and then we saw the leverage that actually was unwound and the way that stopped whole entire market right down. So we're going to sit here and we're pulling back the curtain on everything from Federal Reserve communication or lack thereof, the chaos. We're going to talk about some high-profile family estate lawsuits, semiconductors, free cash flow, the circular tech movement, and how to build an unbreakable anchor into your personal portfolio. Once again, this isn't investment advice. This is just things you can take. Every situation is different, so you have to know your own personal investing situation. But it's just something we're doing right now, letting people know. We have the Wall Street South newsletter. We're going to share our most current edition with you, also published as an article on X. If you're enjoying this, like I said, give us a shout. Give me a 1 if you can hear me, if the audio is good. And we'll jump right into it. So for those who don't know, this is Wall Street South Journal. This is an X version, but it's published on LinkedIn. A little over 1,400 subscribers right now. And so this is just this is a summation of a lot of things that's been happening, right? First of all, I was invited. Thank you to the Titan asset allocators for inviting me down to a special dinner and sitting on a panel. And on the panel, like I said, one of the first questions they asked were about the data center. The next thing they asked about was uh, AI in the data center. Then we got into the conversation of just where we're at in the world in general, right? So, like I said, this is the Wall Street South Journal's July edition breakdown going into August. So it was like a weekly cadence with the newsletter, but now we've moved into a monthly cadence and gone to a much more denser, deep dive look for those. So subscribe to the newsletter, subscribe to this YouTube channel, follow on X or anywhere that you can check out Main Street Meets Wall Street or myself, Marcus Durbin Sr. One thing that jumped out to me, we're talking about, we'll start right where it was. As I was driving down on Wednesday, I got to hear Kevin Warsh's speech in its entirety. So I felt I might be dating myself, but going back to like Green Day and that classic track, Basket Case, and it said, "Do you have time? Listen to me whine about everything and nothing and all at once." And I feel that's kind of like what Kevin Warsh did. He didn't really whine, right? But he just kind of went out there and he spoke, but he didn't really answer. He was kind of vapid in his responses, but maybe that's exactly what he was trying to do. I'm not quite sure. And the markets responded. The market went way down. Well, the markets were already down that day, but once he delivered his speech, the markets went down even further. For those listening, I did air quotes. So another thing we have to realize is that Kevin Warsh has said that he wants to communicate different than Jerome Powell did. So perhaps this is how he's choosing to communicate with the markets by not communicating. He wants less Fed speak. He wants less noise, quote unquote, versus signal. He wants the market to tell the Fed versus how he felt before the market was reacting to the Fed. I kind of thought about it like this, like Jerome Powell, just, even the way they approached the press conferences, because Jerome Powell was very, he would give information in the press conference. But so, yeah, Jerome Powell's like a grandpa or someone sitting on that rocking chair right on the front porch of some like big old estate. He's watching it, right? Watching the whole global market. Everyone's running around, staying in their boundaries. Everyone kind of knows the boundaries of the yard. And then we have Kevin Warsh comes in, right? And Warsh comes in, he grabs the chair, and it's like Christmas or Thanksgiving. I got a really big family, extended family, like at the extended family's house where you got 1,000 people running around, and Warsh kind of just got into the recliner, lazy boy, laid back, and just made everybody run around him to see what happens. And that's not to say that Warsh isn't on top of it. I just think Warsh's style is different. We'll have to see. We'll have to give him the benefit of the doubt. But the bond market, like I said, those interest rates, they started to go up. During the speech, we saw interest rates, yields, I should say, not interest rate, but yields on the treasury bonds start to go up, indicating that the market thinks that rates will be higher and that there's only so long that Warsh will be able to, quote unquote, jawbone or just speak about what's happening in the market. At some point, he's going to have to do something. He's going to have to make a move in these actual markets. It's only going to be so long that he's allowed to just talk. So it's kind of like I said, the lazy boy recliner. And then after that, like the next couple of days, we had people coming in, other Fed chairs, and there's only one Fed chair, other Fed governors, vote members. We had 3 dissents on Wednesday. So it was a 9-3 vote, but the 3 dissenters came out yesterday on Friday, and they were all speaking, saying the reasons for why they dissented, and stating what they see as the path forward for inflation. And they definitely seem like it was higher for longer. Another thing with the Kevin Warsh speech, it seemed to me kind of like when Ryan Cohn was speaking on CNBC, when he was just kind of like half stock, half cash. Like maybe he knows something we don't know. So we'll see. Like I said, but remember though, the bond market is huge. So whether the equity markets are going up and down, we can't really ignore the bond market, right? That's the big part. So a lot of people that bank on bonds, a lot of money invested in bonds globally. It's the big brother. Holds more weight and leverage than the equity market. Well, maybe not more leverage anyway, the way people continue to leverage things, but it's ridiculous. So those are some of the things we're talking about with globally with the Fed and economics. Then in the newsletter, like I said, I want to encompass the total things we talk about money and family, prenups, estate battles, and money dates, right? Because these are some of the things that are in the news right now. We just saw, I just sat down with Ashley Kwame. She's a certified financial behavior behavioral therapist. And we did an interview. It's available on YouTube. It's available. It's available on YouTube. The podcast is out on the Main Street Meets Wall Street podcast. Wherever you get podcasts, it's out there. By the way, if you're finding any value in this video, hit subscribe, hit like, share this with people that you know. But we're talking about families, prenups, estate battles, money dates. And like I said, prenup's a dirty word, apparently, 4-letter word. But it's not. We can see right there it has more than 4 letters. But with the prenup, we were speaking about how it's not necessarily a terrible thing for someone to have a prenup. And then literally as we were speaking about, we saw the Malcolm Jamal Warner prenup thing start to blow up where his widow is suing his estate. So let's sit there for a second and talk about that for a second. His widow is suing his estate. And part of the reason his widow is suing his estate is because it was set up where Malcolm Jamal Warner is supposed to have $1 million in life insurance. And I think it was supposed to be reciprocal. So she would have a policy back in the same way in case she passed away. Anniversary payouts, like $15,000 to $20,000, somewhere in that range on their anniversary, they're one paid out, which, okay. And then there was an annual salary for the role she had in the company and managing, and then guaranteed accounts. So she wanted a retirement account that was fully tax-free, I guess some type of Roth account or something that she could have funded to a certain level, and then college for their children to be funded, which those things aren't outrageous, And I believe at the time, Malcolm Jamal Warner was reported earning about $600K a year between residuals and all those things. Still acting. I mean, he was on the Cosby Show. He was on Malcolm and Eddie, and then he was even on other shows after that. So Malcolm Jamal Warner definitely could have some residuals coming in. Could have. Rest in peace to Malcolm Jamal Warner as well, too. But this situation, like I said, provides a critical lesson. Even when you have a prenup on paper, legal frictions, family obligations, disruptions, disputes, they can still explode. Just got to make sure it's legally tight, and we'll see where it plays out in courts. But none of this matters if they don't do it anyway. We haven't seen it happen. So we'll see how it goes. Like Ashley said, nothing brings out underlying hidden tensions like a good old-fashioned family fight over money. So Ashley, like I said, she was great. When we sat down, we talked about on the podcast, emotional and psychological impact of money. How do couples view money? What do two people in the same household? How can they perceive money so differently? So if you want to check that out, like I said, we got a deep dive into that. But one of the concepts that she spoke on was a money date, which was very interesting to me. So it's where a couple, you and your significant other, she would suggest you do it in the daytime, probably in the lunchtime or somewhere where you just schedule into your work day. I guess it can be virtual. I don't guess she said it can be virtual. It can be virtual. It can be in person. Maybe you're going to get lunch together. And just sit down and talk about your finances. But this is after you've already had conversations to establish where you're at. You'll be surprised how many times you'll see a person who is two people who are married, been married for a long time, sit down and talk with them. Let's talk about your goals, what you want to do when you're retired, where you want to live, how you want to live. And when one spouse says, I want to live in the mountains, one spouse says, I want to live at the beach. Right? So there you go. And that starts the conversation. So before you get into the money date, you got to figure those type of things out too. Probably want to have your budget figured out for those type of things. Then you want to figure out where you're spending, right? But the money date is a good way to make sure that you're actually having some targeted conversations with your spouse or significant other about money, about the ways that you view money, how you're spending money for the month. You don't want to tell someone they're spending money wrong. Ashley, to go back to the conversation, she gave a great example of her husband now has taken up hunting, or maybe he's more of a hunter than he was before. But he's spending a little more time hunting right now. So, and that's the thing they discuss, with hunting. It's not people are like, just stop getting a cup of coffee out every day. I mean, that makes incremental savings, but that's not going to save you, quote unquote, as far as saving goes, money goes. There are other ways to go about it, but you need to figure out if that cup of coffee is important to you, man, if it helps you every day, if it's got to be certain brands you get in there, it's like the middle part of it, maybe you should get your cup of coffee. Maybe you should have that experience every day and figure out another way to save money. But you got to figure out what's important to you when you're spending money, because everyone spends money on something. We usually spend money on what's important to us. So if you can figure out a way to have a money date with your spouse, you and your spouse will just conversating, sitting down, maybe make it a more technical money date, like once a quarter, where you pull out like really hard number spreadsheets, things like that. But one of the points she definitely pointed out that was strong is that you don't want to wait until 9 o'clock at night after working all day to try to have a money date. That's not going to work out well. That's going to lead to nothing but arguments, and nothing's good coming for that. Then you also want to look at the fact as to where the market is right now, where the world is right now. We have inflation going up. We have wages going up. They're not keeping up with each other. The job market seems stable. Where are we going? We have the geopolitical conflict, which I guess we can go into right now. And once again, remember, these are all things that are in the Main Street Meets Wall Street newsletter over on LinkedIn. This is the X version that we're looking at right here that we're reviewing, the article. But yeah, geopolitics, man, they just keep going into it. You can't seem to get enough of these geopolitical events happening all across the globe. Question that was asked to me: what do you think if this conflict turns into a regional conflict? And, is this not already a regional conflict? You got to look at geography. Look at the multiple points of engagement already, if not just by Iran, but by Iran struck a lot of people out there. They, immediately retaliated when this actually already began back in February. And maybe it really began when we bombed the nuclear site at the end of 2025. But I don't know. It seems like there's more people involved every day. I think Hamas agreed to an agreement with President Trump as recently as yesterday. But see, these agreements and these memorandums, they're struggling to stick right now, to say the least. So what we're seeing from them, the memorandums of peace, that's clearly been violated. Shots are being fired. We're back to kinetic warfare. There are reports that Ukraine hit an Iranian ship. I don't think Ukraine denied it. So it's just, this conflict seems to be here for a while. Some reports, and once again, I'm not a geopolitical reporter. Some reports are that Iranian folks feel like they can last longer than we can due to our political situation where we have elections. They don't have elections. It seems like the goals may be changing, but here's just some things for us to think about right here on Main Street, right? Gas pump and voting booth. Like, how long can the average American consumer absorb these elevated gas prices? For it, it just completely dominates the election season. And gas and oil is a big part of inflation, right? What we saw when the war began, we saw really high inflation prints. And then we saw the price of oil come down during this conflict, and we saw inflation prints that were lower than that. So inflation we're seeing it with the pump, and people are feeling it, right? As prices climb, discretionary spending has to slow down because you only have a finite amount of dollars in your budget. It seems like $100 a barrel. We keep seeing it go up and down around that place as a benchmark, right? So we've seen $100, whether it be WTI, so West Texas Intermediary, or we see the Brent crude oil, either way, hovering around $100. And then you got to remember, those are priced like future prices. So those are priced a little bit different, but there's swings up and down. We had Exxon report yesterday, and Exxon missed some of their numbers. Then we have a company like Chevron report yesterday, and Chevron reported blowout numbers. But investing in oil, people want to invest in oil when they saw the war start. Like, that's another thing. So I won't go on a tangent. I won't get too far off on the subject. Like, when you're investing, it's just another reason why a person should have somewhat of a diversified portfolio where you have all your areas covered. So you're not chasing oil. You just already have these oil producers inside of your portfolio. So if they do move, maybe it becomes oversized just due to the growth inside the stock position, the stock price. Like, the stock price just continues to go up. And then at that point, once it reaches a certain level, it would be prudent to trim some of those gains. Because in the long run, energy is a very fickle thing to gain money in. But in situations like this, we see elevated oil, so you can't go in there chasing everything either, And then it seems like there was a while where we had the Monday through Friday, there was peace, and then over the weekend, they were fighting. And markets were resetting every Monday. But that seems to be passing a little bit now. They just seem to be fighting. I know we took a break or a pause a couple of days ago. People were concerned about whether or not there are enough munitions for these battles, where our stockpiles are at good levels. Once again, I'm not a military expert, but the thing about from a main street perspective, or even if from an investment perspective, if you think we need more missiles, you have to look at companies who make the missiles, who are making these missiles. What do you use in war, right? We have the drones that we're trying to use, trying to find a lower cost of war. But like I said, we use oil for everything. Oil is used to transport things. Oil is used to make energy. There's just so many different ways that oil is used, and it's actually like synthetically inside things as well. So oil is inside of a lot of products, petroleum, whatever you want to call it. Our supply right now, we're going into the strategic reserves, probably at a faster rate than we anticipated. I think this war is being drawn out longer than some people anticipated. When I was asked about it in February, I said this thing could last years. I don't know. Hopefully I'm wrong, but that was when they were saying it was only going to be 6 to 8 weeks, maybe, or 8 to 12 weeks. So it's definitely longer than it started out, and probably closer to a year no, it's not close to a year yet. Starting in February. So we're entering what would be the 6th month as it's beginning of August. So, but like I said, that's why you want to be in a constructed portfolio that's well balanced. You want to have exposure to defense and energy already, like in proportionate size. The equal weighted market has made such a strong return this year. And I don't mean particularly market return. I mean like a return to prevalence. People are using it again. People are investing into it again. As we saw with AI and the Mag 7 and tech, we saw that the concentration was so high in those companies. We saw the concentration was so high, it was almost 40% of the S&P 500, which is cap weighted versus equal weighted. And we talked about that in a video I posted earlier this week. If you want to go back and check it out, we were talking about IPOs, Apple, why Apple always wins. What 401ks, we actually went on a little history guide with 401ks and why people invest in them, why they should invest in them, why they do invest in them, how they came about with the death of the pension. But I was saying before, so we're seeing rotations inside the market back to an equal weight. That cap weight was when it was nearly 40% of your portfolio. Think, like I said, with Asia and the Kospi over there, where you have pretty much two stocks, Samsung, SanDisk, they're making up the whole entire over half of the index. And when you see those go down, you saw the drastic losses that we saw over there this week. And we saw sell-offs inside of America as well. The week finished strong, but it was choppy. It's very interesting sessions, interesting data. But like I said, we're going back to the markets and market dynamics. So at the end of the day with the markets, it was a big week for earnings. In the last week, we've had like 4 hyperscalers report last week. Well, I guess this week, but the week before we had Alphabet or Gemini report. This week we had Meta, Microsoft, Apple. So yeah, and here we're talking more about it. The thing that investors seem to be concerned about: return on investment and free cash flow. And how are we funding the AI build out, right? Are they funding this AI build out through free cash flow or through debt? How is it being funded? Those are some of the big questions that are being asked right now. That's what people want to know. And with regards to it, I would say both. We'll just look at it. And this is all in the newsletter. So please check out the article on X, check out the newsletter over there on LinkedIn, subscribe to it. If we're not connected on LinkedIn, let's connect on LinkedIn. Check out the ABC Squared. That's the company page, is where it's at on X. I don't have a personal X page, but the company has an X page and then the YouTube page. So, and this will be on the YouTube page and the Main Street Meets Wall Street podcast. This information is out there if you want to receive it. We're out there. We're putting it out there for the world to see. Like I said on the podcast, we have a lot of great people in there, and we still have more people coming up. Just finished recording one with Sarah Grillo. She brings a lot of great information. Tara Ross, we have his episode coming up, where the Bitcoin bull case is coming up. That comes out this week. Part 1 of that. We've had the Bitcoin bear case for folks who want to hear the bear case to Bitcoin. We have war reports going since the war started, where we were doing some live sessions, and we also had some record sessions, and we just put them into hour-long sessions that you can sit back and watch and see the war kind of document in real time. So the war report's a very cool thing. Then we also have very cool guests who come onto the podcast and break down things for us. I've helped Main Street meets Wall Street. So it's usually with the guests. When we do it Tuesdays, you can catch the episode with the guests, and then Saturdays, something like this. Saturday, Sunday, over the weekend, we like to release something a little bit different. It's usually just me solo breaking down information or some things I've been quoting in the media. I don't want to go too far or digress. Another big thing, which actually I think could actually tie all into this AI play out, AI build out. And if a bubble was to happen, is the buy now, pay later craze is going on. And I say craze because it's starting to get really extended. That leverage that people are using, and people are getting into the wrong mindset with it. Stories of people who are ordering $40 worth of Chick-fil-A while living at home with their parents, splitting the payments, not because they have to, but just kind of because that's their condition. It's easier in their mind to pay it off. And if you can't pay it off at 0% interest, I get it. Cash is tough, affordability is high. But if you don't, these buy now, pay later loans end up becoming pretty much like credit cards, where you have high interest rates that you have to pay it back, and they could impact your credit in a negative way. Because some of these do report when you make payments on time, but I guarantee you when you aren't making the payments, they're going to report them. So you have to look out for the on-time payments, and then the payments that you don't make on time. So buy now, pay later, just be careful with it. Watch out. Be careful if you're out there doing it. I always think about like layaway, but the thing with layaway is you didn't get the product in layaway until you had actually paid for the product. So that's a huge difference from what we're seeing right now with buy now, pay later. Buy now, pay later, you're literally buying it, getting it, and paying later. So if we see that, we see a consumer continue to struggle there, that could be another sign, something that's coming with busting a bubble or a bust economically. And people blame it on AI, whatever sector may bring to them, because AI has been the big buzzword. But like we said, Meta, Microsoft, they both reported different results, right? Meta reported they were going to spend more cash, but they didn't necessarily have a clear path. I think Zuckerberg he's been penalized before for some of his spending, excessive spending. It seems like he chases dreams sometimes, but I guess that's how he got to be where he was, chasing dreams and creating things that other people couldn't see. Microsoft had been underperforming all year, but they gave a great quarter. They gave great guidance. They have a great plan for their free cash flow. And they said they're going to reinvest too, but we saw their stock have, I think, its best day in like 20 some odd years. One of the best days in the index in a long time as well for the overall stock index, just by a market gain and market share. So, but then we go back to Google the week before, and Google increased their capital expenditures for the AI build out and managed the liquidity and equity issuance. I think Alphabet was initially down, but it's come back since then. So it's not like Meta is still being punished. Apple reported Apple stock was down initially, but Apple had been one of the best performing stocks in of the hyperscalers for sure. It was the winner. It had overtaken NVIDIA again as the world's most valuable company by market cap, as we saw semiconductors continue to get punished as the rotation happens in this market. Once again, that concentration risk that I was talking about, but we see semiconductors that got destroyed. And like if you just look at the Philadelphia SOX or the SMH, two semiconductor indexes versus like the IGV, that's a software index that covers software companies, you saw that flipping all of them. And then Oracle, oh my goodness. Oracle is the poster child for AI spending and the way you spend, and whether or not this is going to be one of the AI winners or losers, or how to go about AI. First in, first out with Oracle, maybe because they were one of the first ones to come out and not say how much debt they were going to issue, but issue out a lot of debt after their blowout report, because they did pretty much right after they had a blowout report last year. Like we said, we saw the stock skyrocket up over $300. And now the stock's got hammered back down like the 120s, and the stock stock has momentum. That's a low level, but it just illustrates how sensitive Wall Street really is when it comes to capital expenditure spending. But Larry Ellison has a track record as well of leverage and people thinking he's down and out and somehow pulling it off. You don't get to be one of the richest people in the world by not taking risks, almost losing it, and making it back. Look at pretty much all the richest people in the world. They've had some move or some sort like that. And not to say that wealth is a measure of anything other than dollars, right? Dollars are not wealth. Wealth is different for every person, but you need a certain dollar amount to function in the world, to live in the world, to meet Maslow's hierarchy, where you're not worried about sleeping or shelter or feeding yourself or your family, right? Then you start thinking about wealth and things above and beyond that. But like we were saying, the Cosby, the concentration and leverage, you want to see the real world warning shot regarding concentration risk and systematic leverage. Like I said, look at South Korea. That Cosby index was so heavily concentrated, right, that they had to call in the foreign minister. That dude was about to lose his job, and decrease some of the leverage. They took some of the leverage that you can have over there anymore. You can't be 3, 4, 5 times leverage like they were before. I think maybe you can have one leverage now. But leverage, like I said, can magnify your gains, but it can be terrible on the way down. It will destroy your capital faster than not at a casino. Position size is just as critical as risk management, like for real. You have to, because if you're over, position size is a part of risk management. So if you're over extending the position size, like we're talking about, like say we're diversified in our portfolio, we have the oil companies like Chevron and Exxon, and then they grow. Now this position size has grown. Or even right here with the Cosby, maybe you got in the Micron, which isn't a Cosby, just like the memory trade is also tied in this. We saw the memory trade go away, the DRAM trade. You have one of those companies and they're getting just killed or punished, and you're leveraged. You want to see it even worse. So be careful with leverage, margins, shorting stocks. Just, if you don't understand all these things, trees don't grow to the sky. Just figure out your risk tolerance and invest based on it. Don't chase the next best thing. Know your investment thesis. There are a few reasons why you should change it. Few things happening in the world that'll make you change it. You have to know your investment thesis and know why. Speaking of investment thesis and knowing why, I was speaking with David Snyder, the man who predicted the .com bubble, and a CNBC mystery broker to Michael Santoli. We were speaking about he sees the AI. He sees the AI as a bubble. This was a few months ago. He was telling me with the AI bubble, I was like, what are signs people can look for a bubble in the AI? And he said, well, one of the things people can look for will be SpaceX, OpenAI, Anthropic all coming out and going public. Because once they all come out and go public, that'll be a lot of capital. He said pretty much most of the capital is exhausted. One of the things, one of the signals that you look for. So we're not going to get too deep into whether it's a bubble or not, but we are going to talk about these IPOs. A couple things to note with IPOs, like lately, vast majority of IPOs are down like 50%, 12 months after your listing date, right? So think about SpaceX. Some of the gains we saw in it, 220 post IPO, but 135. So I guess technically you could see it hit 65. I don't know. The 60 levels, or it could surge back to 200. SpaceX is a little bit different when it comes to that. SpaceX has the cult following. That SpaceX, the cult following, so like from Tesla, some of the original retail investors like GameStop, meme-stop type things were like Tesla investors before GameStop and meme-stops. So, and if you live on this planet, you know that there are few people as diverse, and not even from, well, maybe from his actions, but we're not getting to his actions, but that people have such diametric views of than Elon Musk. Some people will continue to buy this stock because it's Elon Musk. Some people will never buy this stock because it's Elon Musk. That's for each his own on that one, Main Street, but you'd be you would have a lot smaller pool of stocks to choose from if you invested based off the person that runs the company. I'll just leave it at that. But another thing that came out with SpaceX, people were expecting SpaceX to buy Tesla, which could still happen. But SpaceX has the government contracts, and the SpaceX wants to buy Tesla. And this was reported or a leak. Elon Musk actually denied it, that Tesla would be divesting from his China interests in some sort of separation or some sort of pulling apart of the company. Oh, that word is leaving my brain right now. But like, well, Honeywell did it, GE Verona did it. Where you break it down for the sum of the parts. But they could do something like that and then leave the interest in China. And that way you wouldn't have to worry about the security interest. But Elon Musk said that had not ever been reported or ever even talked about. And that was faulty reporting, but we'll see. I think China has a different type of set of rules if you want to leave China or maybe you want to stay in China. Either way, I think China has a little more control than on their companies than America does for now anyway. But like we said, we got OpenAI and Anthropic preparing for their public listings over the next 12 months, and people really talking about the circular investments again. It's part of the reason why we saw companies like NVIDIA take a big hit here recently. We saw tech giants that are investing in NVIDIA actually made another investment to, I think it was Anthropic earlier this week. I discussed that deeper in one of my videos from earlier this week. But yes, we see that right there. And people are wondering where exactly this money going to come from? Where's this money? How's it getting back to them? For this cloud computing, how much it's going to cost. And then you have reports coming from China, where the Chinese companies are building these products out and building out these same type of things for for fewer costs, less tokens, cheaper type tokens. Because now it's becoming about tokens and tokenization. Cost of tokens, cost per token, what kind of quality are you going to get from your work for a token? When they first came out, I realized it was about tokens. People were buying tokens and token maxing, you know, and then I think corporations say, oh, that's really expensive. We need to pull back here and figure out a more efficient way. And then, like I said, you see the China companies coming out over there with models that are just cheaper models. I think we saw maybe it was Alibaba giving some NVIDIA chips to some companies in China, smoking some over there to some companies in China, and they just build off of those NVIDIA chips to grow their AI companies. So like go in there, clone them, and increase their increase their AI capacity. Obviously at a cheaper price. I mean, if you're getting it free, it's pretty much a lot cheaper than what they're paying. So you have that, the circle investment. We just saw people a lot of concern with AI and the AI build out. And then also with the way AI is financed, and we saw the leverage go into effect from the private investor who Ken Griffin and the Citadel came in to quote unquote save. His fund was up to like 45 billion, but it was so highly levered. I think they probably sold it for parts for like 10 billion, and I say that like that's a little bit of money. And who knows what Citadel's going to do with it. But I'm sure Ken Griffin has a plan for it to make multiples on that investment versus what they paid for it. But it was highly levered into like memory stocks and into the Kospi over there. And when it worked, it worked. But when it stopped working, like these are rotations and these are realities of the market. Like when it stopped working and when it has that much momentum, it's just whoosh, you can be hit really hard. People's life savings or trillions of dollars just wiped out. Speaking of trillions of dollars been wiped out, like an example. So when SpaceX first came out, it initially made Elon Musk a trillionaire within like the first week, maybe like within the first weekend, they bought a company for like several hundred billion. The company they bought actually was pretty much the same amount of market cap that they gained in stock price over that time, which is interesting in itself before the stock went back down. But they're taking some of that money and we're buying other things, growing that company. Like I said, this goes back to circle investments maybe. But here we are and we're at the equal weight, like how the markets are moving. Capital is moving away from that hyper concentration back to equal weight indexes, one equal weight index. And this is a stock recommendation. None of these things we've said, just to repeat, are stock recommendations, but they're just stocks that you can look at. So capital is moving away from the hyper concentration. Small caps have been leading for like over a year. I don't think people realize that. Small caps have been running. If we do get rate hikes, that could definitely do something to the small cap rotation that we've seen. because higher rates will impact smaller businesses more than they will impact larger business. We recently saw 50% tariffs implemented on Canada. So how will these be passed through down to corporations, to consumers? And then, we got the debt wall going on. So we got the metric flash when it signs $40 trillion. And then that serviceable debt's like 160 trillion. So a lot of debt that we have to service right now, which ties back into the interest rate conversation that people are having. Will we have lower interest rates, which will make it easier to service the debt? That's why people ask, will we have lower interest rates as well? Make it easier for people to buy homes. And these are all in theory. I mean, with the rate cuts, right? Because the truth is the Fed cut rates several times under Jerome Powell and the stock market went up. So you had several rate cuts and then you had the stock market go up. So where is the stock market going? Think you're going to see more bumps in the stock market and volatility until we reach the election. Then hopefully we have some clean, clear elections that can carry us in and through the stock market. Once the stock market has clarity, I expect it to go up. But we'll see what happens in between now and then. A lot of volatility, a lot of things are happening. Like I said, we still have a war happening right now. Tariffs are coming back. How are these tariffs implemented and impacting the world? How is inflation hitting consumers? Which one of these big companies that everyone's banking to win is not going to win? We'll see. Or who's going to zero? Someone's going to zero. We haven't even talked about crypto. Crypto's a thing that seems to be coming back as well. But just a lot going on. And then cybersecurity, right? So we'll talk about a little bit about cybersecurity. Over the last few weeks, we've seen Anthropic's model, I think it was Anthropic's model, hack into other places, hack into other companies, hack into other models. Hugging Face is one that hacked in, and it's doing this outside of the perimeters that it's being trained to do, right? There you go. Claude Anthropic, right? Yeah, so Hugging Face goes in there, and then I think as recently as yesterday, they announced like 3 more interfaces that were breached. These AI models are supposed to be in sandboxes, but they're getting outside the sandboxes. The first one, it was supposed to be a test, but the AI model decided that the test was too hard, or maybe it just decided there was an easier way by going into, instead of solving the answers for the test, just go to the source for the test. So one thing to think about with that is, back in the 80s, 90s, Microsoft really dominated the world because it had enterprise like software that people could put on the computer, and it was in everyone's operating system. Pretty much you had to have Windows for a while, a monopoly. I believe they got sued for it. If I remember correctly, Microsoft got sued for that. Could cybersecurity be the next layer like that? And there's a company that's leading like CrowdStrike. Well, is that going to be like the next Microsoft? Once again, not investment advice, not a single stock recommendation, but is CrowdStrike or Zscaler or Palo Alto, or is that a company that's going to be like Microsoft? Now we're seeing the increased need for cybersecurity, especially with large amounts of capital. Not to mention a company like Palantir. Palantir is really deep with government contracts, and they're so layered inside of defense and cybersecurity. Maybe they could be a winner inside of this movement to cybersecurity. But cybersecurity stocks also, they go strong with software. I don't know if people remember back in February where we had that SaaS apocalypse, and it just kind of became a rotating SaaS apocalypse. Cybersecurity, financials, every industry. I think the trash industry got disrupted 1 week because of something with AI. We saw Allbirds go from a shoe company to an AI company. So just rotating AI bubble popping around, right? And that's another thing. That was another question. Like I said, people ask if there was a bubble with AI. And I would say, I actually did say, so this is how I describe it. I don't think it's a bubble per se. If it is, we're all in and we all know it. But it's like a building. I got even deeper into my thought about it from where I answered the council. So it's like a building. It's like when you're building a building as well. So you gotta put up like the framing, and I don't build buildings, right? You gotta put the framing on this side or whatever you're going to do, but you gotta put up before big walls outside, however big the building is, right? You got to have 4 walls. So like the AI, in my opinion, is like so far as the 4 big walls. This is a huge building. Then they're going to break off into different sections, like rooms inside the building, and that's what's happening inside AI. So like different rooms are popping and different rooms are bubbling. That pressure's going, but it's all the same. It's all in the same house. Hopefully, the whole house doesn't catch on fire at one time. So maybe that's the difference of what we're seeing right now. So, is it a bubble? If it is, like we're in it and we know it. It's irrational exuberance all over again, perhaps. Is this time different? They rhyme, but they're never really different, right? But they're always different. They're different calluses, I guess you should say, right? Whether it be the 87 crash from that stock market just running hot, whether it be, the 99.com bubble where that stock market went hot from everyone thinking that the internet was going to change the world, which it did. I mean, if it was for internet, we wouldn't be sitting here doing this right now and having the AI conversation, to the housing bubble, which the world knew about. Well, not the world, but people definitely knew they were putting together trash products and junk and selling them. And they were essentially betting against the products that they were putting out. I digress. That really ruined a lot of stuff for people of this generation right now. There are a lot of people who were children in '08 and saw their parents lose their houses and have to move or lose their jobs or get divorced. It's just a lot of things that came from a situation that could have been avoided. You just can't give subprime mortgages to everyone. People who can't afford it. And then, and we have to know where we're at inside this bubble and be positioned properly. Okay. We talked about concentration risk. I spoke about concentration risk inside this conversation as well. Like inside your portfolio, anything you're investing in, you can't have, a simple way of saying is you don't have all your eggs in one basket. What do you think about building our portfolio, right? And this isn't a, once again, not a stock recommendation or a plug for Apple or any individual stock, but Apple seems to win, right? We'll talk about why Apple wins in the long run. There's an article right there in the video right here. And once again, this is all in the newsletter that I wrote for LinkedIn. It's a long newsletter, but this is the article on X right here that we're reviewing. It's just reviewing the markets in the month. But Apple wins in the long run. Not a recommendation for Apple, for or against Apple, but why does Apple win in the long run? Like, just think about it. Apple sent me a message the other day, said they were increasing my Apple Music price, and I didn't cancel my Apple Music or my Apple monthly subscription. They only increased it by $1, right? So we're in here and we're sitting in a water bowl, or we're going to jump out. I don't know. We'll see. Everyone else was spending so much money on CapEx, capital expenditures, right? Last year, and Apple stock was being destroyed for it, being destroyed for the capital expenditure because they weren't spending money, right? I said to other people, I said it's a good bit, like the early bird gets the worm, but the second mouse gets the cheese, right? And Apple may be the second, third, fourth mouse, right? And I got a video on this from earlier this week where I go deeper into Apple and all of these things, as well as why they win in the long run. And they just reported and their stock actually went down. So maybe that's an opportunity to look at a stock like Apple. And it doesn't just have to be Apple, but we are going to talk about Apple right now, like Apple specific. But people were being rewarded for spending money last year. And now we see with stock, people are being punished for spending too much money if they don't have a clear plan of where that money is going. So they were burning through their cash on data centers and free cash flow. And Apple has a fortress of a balance sheet. Apple has more cash than a lot of countries in the world. Like Apple would be one of the larger economies in the world just based on how much cash that corporation has. And Apple has so many levers and so many things that they can pull, so many things that they have invested in, Apple phones, Apple devices, Apple subscription, Apple TV, just so many things with Apple. And then just to bring in with Apple, like half the world's already built in as Apple users, and people usually don't switch. So then they have the partnership with Google. And this is another thing. People hear these things. This is all on the media right now, like the mainstream media. There's Apple stuff. Go get Apple, go get Apple, go get Apple. But other people have been talking about it. I was talking about this Apple for over a year. I've been talking about this for Apple for like well over a year. Pretty much anytime anyone asks me about Apple, I'm like, yeah, it's probably not a bad time to invest in Apple. Once again, not a stock recommendation, but reasons why, and people say Apple's price highs, price over the market multiple, like 35, 37, 38. Well, Apple's a premium. It's the most valuable company in the world by market cap. So you're probably about to pay a premium for that. You pay a premium for premium products, but you also should expect a premium return, which Apple had not been delivering for a while. A premium return, like we said, we saw the stock trading sideways and trading down, but now it's been one of the better performers this year until recently when they report. And I was asked a question on South Korean TV, K-Pro TV, earlier this year, asked about, and Apple or Alphabet. And like I said at the time, it's hard to go wrong with either one of them, but I do like Apple. And this was a time when Alphabet and Apple had just went into their strategic partnership. Apple is paying Alphabet a subscription fee for them to use it. But at the end of the day, you got to realize that it all comes back to Apple, right? People always come back to Apple. All these tools, all these platforms, whatever OpenAI is building, it's going to be on Apple. All these AI interfaces, the Uber app, whatever you're thinking about, is going to be on your iPhone. At the end of the day, people just want to tap that app and get to it. So the App Store is so powerful. Now, Apple's now a rosy, right? Like I said, you have the multiple that's above the market level. So there are definitely opportunities with companies with lower multiples, although the multiple probably came down some with the price depreciating this week from the stock selling off a little bit, but it had been on the run, a great run. One thing to look at is the leadership transition. Apple has coming in. Tim Cook is taking his final earnings call. That was Sunday, or I'm sorry, that was Wednesday. So the next one will be from John Ternus, who comes in September. Watch out for his expansion plan. We'll see. Like I said, Apple has already built in a lot of user base. Apple went and spent a lot of money on AI. Apple has kind of said a couple things that they want to kind of do now with AI, maybe playing some stuff with Siri. And Apple's hardware failures have been of note here lately, right? I think the 17 got a better response than most people expected, and now they're launching 18. So perhaps with those product launches of the hardware, we can see some appreciation as well, like see some growth towards earnings in Apple. But you also have to remember Apple, and people were calling for Apple to acquire something last year. Why is Apple not buying this? Why is Apple not buying that? Apple hasn't really been making a lot of acquisitions. They have had a lot of brain drain, so a lot of people leaving from the top. But Apple is built to last. People thought that Apple was going to be, dead in the water when Steve Jobs passed away and Tim Cook took over because you have Steve Jobs, who was a visionary, and you had Tim Cook, who was a supply chain guy. Turns out you need a supply chain guy for COVID, right? When the whole world shut down, you needed someone who could navigate supply chains. That's one of the reasons we saw Apple continue to not just survive, but thrive during that time. They had stock split. I remember stock was down like $100 when they did that split. So Apple's a strong play. Once again, not stock recommendation, but find a stock if you are looking for like a stock, some type of stock. Find a stock like that, right? So that's what I mean by like find an anchor stock. Find some stocks that you can grow on. And if you've never invested, you probably should base it on some type of index or ETF that mirrors the market, right? As a big part of your core position, right? Think about like you have a jar. You got rock, big rock that is most important. And you have little pebbles. Then you have sand. Pebbles are kind of important. The sand is just like frivolous stuff, right? You want to fill but all of it makes 100% of your portfolio. I don't want to say frivolous. It's smaller, right? You got to figure out how to fill that jar up, which the lid's going to be smaller a little bit than the rest. It's going to be kind of shaped like that. So you got to figure out how to fill that whole jar, right? If you just put the big part in, you just put the rock in there first, and then you build around it. Are you going to be able to get everything in there? So maybe you want to build your base with a little bit of that sand, right? We can say now the sand's like small caps, right? So you have a little bit of that sand in there, then you put the rock in there. That's taking up a lot, maybe some large cap allocation. Then you put the pebbles around it, the mid caps section. Then you got the whole portfolio in there. You got everything inside the rock. And it's not over proportionate. But like I said, if you're doing it with like market indexes, something that's just mirroring the market, that should take care of that for you as far as like diversification, make sure that you have everything inside your portfolio. Because once again, with Main Street meets Wall Street and the conversation we have, trying to give you actionable steps that you can take and things that you can do, ways that you can grow like things you can do today, tomorrow, like things that you don't have to wait and do, things that don't seem um, so downtrodden for people, right? And then, like I said, so back to equities, capture the headlines, but bond market big brother, right? When Warsh was speaking, Treasury yields pushed higher. The bond market looked at the Fed and simply said, man, you can say whatever you want. You keep talking about that 2% target, which you hadn't hit in 5 years or longer. And, inflation's the closest it's been has been in the threes, right? Low threes, maybe it touched some high twos. But Kevin Warsh also said his inflation numbers, he's looking to the left of the decimal, so he wants that too. Then he said, so this is more of the Warsh talk that we're getting, that he is concerned that when he says 2, I think he means 2.0 for an inflation target. Different from the first speech versus the second speech he gave. But we had the huge stimulus injections. I mean, pretty much across multiple presidential administrations for decades, right? Like, let's be clear on all that. It's not just Biden and Trump who did that. And now people are going to turn to Jackson Hole in August to see, which isn't, quote unquote Fed meeting, but he's definitely going to come out and say something. As Warsh said that he would speak for the Fed committed to give speeches for the rest of this year. He will reevaluate after that. So he'll speak in Jackson Hole. He'll speak at the September meeting. I think they have maybe 2 more meetings after the September meeting. So he'll speak for those. But the market should adjust to like Kevin Warsh's style right now. That what Kevin Warsh is saying is not, he wants the market to take care of it. The market's going to make the Fed do something. They're not just going to sit here and keep letting Kevin Warsh make the market take care of it. So it'll be interesting to see. But you got to maintain proper position. You got to schedule your money dates, folks, and you got to be in this for the long term. Don't let the short term noise and short term signals distract you from what you're doing, from where you're trying to get to in life. From the goals that you have, from the economic principles that you've based on your plan. Unless any of that's changed, stay in there. If anything, maybe you need to double down when turmoil comes in the markets. Because guess what? Every 5 years or so, the market's going to get hit. And you're going to lose a decent amount that you hold. Considering if you've been inside this market the whole time, you've just been watching it go up, it's going to feel like a real big amount. But what you have to do, and this is where financial professionals or someone else can help you generally, because it's hard for us to have that mindset alone, is you have to remember why you're invested. And if you stay invested, history's shown us, and I can't speak for the future, but history has shown us that if you stay invested through these market downturns, and when market downturns happen, you'll be rewarded markedly on the other side, like multiple. We've seen some generational wealth. Like I said, I walked into the room and I told, I said, Marcus Sturman Sr., drove down here from the Wall Street South, Charlotte, North Carolina. And I was in Atlanta, and the Atlanta folks looked at me like I was crazy. But y'all gotta watch out for Charlotte. Like I said, we got $4 trillion in assets. We got BA here. Truist is here. Wells Fargo has a big thing here. Financial heavyweights like Truist came here when they were in Winston-Salem. Wells Fargo's got their most employees here. And then pretty much every major service here. Even JP Morgan just came down here. JP Morgan Chase came down here. I think it was the end of last year. Saw Jamie Dimon doing an interview from office. This is in Charlotte. A lot of financial workforce. I know a lot of people who work in the financial workforce here in Charlotte. Charlotte's one of the biggest and largest growing cities. And our mega banks control a lot of our local deposits. So, like I said, Charlotte is just, with the Wall Street South. Sorry. I mean, it's not a bad thing. And a lot of people are like, oh, it is what it is. Like, Wall Street is South represent. That's pretty much the newsletter that we went over. Like I said, if you want to read this, it's a 10 to 15 minute read. But it's definitely worth it. If you want to go more in depth on some of the things that we were talking about. Some other things that, just so you're not reading the letter the whole time, just take a few minutes and wrap this up real quick, We did get a GDP report. It came back a little bit lower than expected. So we're seeing GDP maybe contract. We'll see how that works out. But that was, we had the war in Q2. So Q2, AI valuation reality versus the actual premium that we're seeing in this market. Don't let AI and AI build out have you over concentrated inside your portfolio right now. Because we've seen that whipsaw goes both ways. Then we talked about estates, family money dates. Make sure we are planning these money dates, that you're sitting down with your loved one, you're preserving your wealth, you're doing the things you need to do. Y'all are having these conversations. Make sure they're structured, make sure they're really happening. Some things you can do, like I said, actionable steps. Make sure you have beneficiaries designated on your accounts. If you remarried or something to that effect, make sure you have proper updated beneficiaries, because I don't think very many people are going to be happy if they pass away and their ex-spouse, while they have a current spouse, gets the stuff. So make sure you have those updated. Make sure you have rebalancing set up the way it is. Make sure your generational transfer strategies, they align with tax laws. Like, if you want to set up a trust, you probably should spend some money and get a trust attorney to help you set that thing up the proper way. And then just remember, like the Malcolm Jamal Warner situation, just because you have a prenup or a trust, or whatever you may have, things can change and people can contest them, and we'll see how the law plays out for it. We say will oil hit $100? That's going to be a big level. If oil hits $100, and then maybe we'll see interest rates. And this isn't necessarily saying that they'll be tied together, but they could be. Oil $100, interest rates at 5% for the 10-year. The 10-year is like 4.7 right now, but if we see the 10-year is like 5%, people are conditioned in their mind to go more risk off because they feel like 5% risk free is a great return. I would say, is it really 5% risk free though? First of all, everyone could default. The U.S. government probably won't. They never have not paid a bill. But if it's 5% return, and then you are, let's say inflation is 3.5%, you're really only getting 1.5% on that cash back in real return, which is another reason why equities generally outperform in the long run, because you're generally going to get 7 to 10% historically on the equities. Like, if you look back over like the last 100 years, let's say when inflation, there's a reason why they say 2% is a target. Let's say it's potentially 2%. That's a larger real return than if your cash was getting 4%. So we'll see how it goes. We'll see how portfolios are hedging against it. We'll see if gold comes back into play, if metals come back into play for more than just the AI build out. So we'll see if like the actual precious metals become a thing. So that'll also be a sign that people are worried about money and the stock market. We've seen the dollar firm up here just continue to go up. So that would also be another thing that could be impacted by interest rates. And we're seeing maybe as the dollar firms up, people are saying, yeah, we think the rates are going to go higher for the cost of capital. CapEx, cybersecurity, right? So tech earnings, you got to look out for CapEx. We need to see where this money's going, where they're spending these dollars, where they're actually going right now. This IPO window is going to be key. We've seen several of the big ones push their announced date back to properly the beginning of 2027 or some point within the next year, whereas people would have thought that they probably all three were going to come this year. Watch the earnings with the cybersecurity, right? Because if they continue to spend, it's eventually going to compress your margins. I mean, you can only spend so much with the earnings before you take it away and you're in bad shape, like really bad shape. And that could just happen overnight. So watch how these firms are financing their debt, how this debt's being financed, and where the money's coming from. And what's the ROI is, return on investment. And like I said, Charlotte, man, where the Wall Street is South. Like, people can hate, people can say whatever they want, but Charlotte's the Wall Street of the South. I want to take a minute and just thank people. I want to thank y'all for the people who tune in, the people who read the newsletter, people who listen to the podcast, the people who support the channel, the people who pop in and say, like, share, subscribe. Like, appreciate that stuff. I want to show you the newsletter. Like I said, that was the LinkedIn version that I just showed you. I mean, that was the X version. Here's the LinkedIn version. Like I said, we're sitting 1,400 subscribers, over 1,400 subscribers. I love that picture of Warsh and Powell. And then It's the latest edition right here. So it just came out. And it's a 15-minute or so read. But it also has videos in there to, you know, help you dive deeper into some of the concepts that we're talking about. So video there with Mr. George Hoppenfuller. Sorry to go so fast. The debt, we're talking about the debt in one of the videos. It's a tranche of wealth right here, a wealth of knowledge. Actually, now talking about couples and money, reason money and couples. That was a great conversation. 2 parts to it, actually. Then actually one with Mr. Derek Kinney. Derek has a great conversation, ways to think about the economy and volatility. If you're an advisor, how to talk to your clients during these times, or how to grow your business, or whether you're just dealing with your own personal financial economy, which all of us are, right? We all have our own personal CEOs or personal financial economies that we're dealing with and that we're trying to grow. So his is great for that. And then, oh yeah, great conversation with Ryan from over at Benzinga. Great conversation. He hosts the Pre-Market Playbook show. We just talked a lot about noise versus signal. Ryan's a Bears fan. For those who don't know, AI made that shirt logo. I don't know why he made it like that. Ryan's a Bears fan. He had on Bears shirt, but you should check it out. It's a great conversation and just some of the things they're doing over there at Benzinga. It's really, really cool stuff. I actually have a Benzinga link that I can put into leave in the show notes for folks so you can check it out. Use my link and I may be compensated, but it won't cost you anything extra. Speaking of Benzinga, there's another conversation I had with Benzinga with Brad Olson, the chief content officer over there at Benzinga. So that was a great conversation as well. That may be part 2 of 2 with Brad. And then we talk about the cybersecurity. Oh, and then that's the video. So I was talking about a video I did earlier where we were talking about Apple and breaking down some of those companies. That's it right there. So, and also in the backside of that video, I take like the last 30 minutes to talk about just 401ks, history of 401ks, like how they were written out until like 1978. They were pretty much a loophole that someone discovered in the early 80s. Like they were only for high ranking executives. It was kind of for executive compensation is why they came about with the 401ks. And then people realized that there was an evolution and how 401ks actually meant, a good reason to push some of the honest back onto the individual. So we talk about defined benefit plan versus defined contribution plan in that video as well. So for that, just real quick, high level, let's say defined benefit plan. You're going to get X amount as long as you're going to get this benefit. Think of pension, you'll get an annuitized amount of money for the rest of your life as long as you put in this amount and follow these rules. So that's defined benefit. Whereas with defined contribution, where it's just say, if you put this amount of money into this plan, you may get this return. It's not a guaranteed benefit. It's up to you that you do it. For one, that you put the money in there, and 2, you pick the investments in. So that's defined contribution. Like you're defining that you contribute. It once again just pushes the onus back to the individual. And then right here we have a deep dive on SpaceX IPO. That video actually has several interviews from SpaceX's, like straight from their mouth, the CEO. So yeah, Musk is talking to the CFO, and they're talking about their vision and goes through their history. So it's a good conversation right there. And then for anyone, like I said, this is the LinkedIn version. So anyone who wants to grow on LinkedIn, like how to make a good post, what people are looking for on LinkedIn, why LinkedIn is great, what LinkedIn is good for. That conversation with John Tomasi is right there on the newsletter as well. So like I said, the LinkedIn newsletter is a lot, this one. And then it also has the podcast that you can check out, link to the podcast and link to the YouTube channel. So yeah, Main Street, that's a lot. Showing you a lot here, talked about a lot. We're about to sign off here. We're going for about an hour now. I just want a little over an hour. I just want the people hit the like button and subscribe, share this with someone. For anyone who has yet to experience Main Street Meets Wall Street, or anyone who has not heard the podcast, not seen the channel, check it out. Come through. This football season, so we got the Raiders, Panthers. It's that time of year. Fantasy football is kicking off. But Main Street Heart, Wall Street Smarts. Like I said, check out the podcast. We have some really good people coming on. This one was live. We're refurbished. You'll be able to catch it later on. Main Street Heart meets Wall Street Smarts. Hit that like button, subscribe, share this. Thanks, Main Street.